The modern auditing landscape didn't emerge from a vacuum. Over the last 30 years, a series of catastrophic corporate failures severely eroded public confidence in financial reporting. The most prominent catalyst for international regulatory change was the sudden collapse of the energy giant Enron in 2001, or Anderson. Governments reacted immediately. To regain trust in the auditing profession, lawmakers introduced sweeping national laws, such as the Sarbanes-Oxley Act in the United States. Public trust in financial markets is now maintained through a specific engineering of the profession, harmonized procedures across borders, strict ethical codes, and a focus on audit quality. To achieve this trust, practitioners operate within a highly specific, layered regulatory guidance system. The first pillar of this system is national corporate law. These statutes dictate the strict legal parameters and requirements of an audit within a specific country. The second pillar consists of professional standards. These rules dictate the ethical boundaries and the methodology used to execute the audit itself. This diagram shows the structure. You have rules and regulation at the top, splitting into legal requirements on one side and professional standards on the other. These distinct pillars are separate, but they connect to govern every action an auditor takes. To understand how an audit works in practice, we have to deconstruct this regulatory scaffolding layer by layer, starting with the hard legal requirements. The national legal layer establishes the baseline rules, starting with a foundational question: which companies require an audit? In most jurisdictions, while companies are required by law to have an audit, small or owner-managed businesses are generally exempt. The macroeconomic rationale for this exemption is straightforward. If a small company's financial statements contain misstatements, the impact is unlikely to be material to the wider economy. For the company itself, the financial cost and the business disruption of undergoing a full audit often outweigh the potential benefits. For larger entities that do require an audit, a critical legal question arises: who holds the power to hire the auditor? The law places this power with the company's members, the shareholders, who appoint the auditor by voting them in at a general meeting. Crucially, the company's directors do not generally appoint the auditor. This separation prevents a direct conflict of interest between those managing the company and those grading the financial results. There is a minor exception. Directors can appoint the first auditor or fill a mid-year vacancy, but even then, the decision requires shareholder approval at a subsequent meeting. Whoever is chosen must meet strict eligibility requirements. The individual must be a member of a recognized supervisory body, or RSB, or be directly authorized by the state. Stripping the power of appointment from daily management and giving it to shareholders creates a legal boundary that protects the auditor's independence. Once appointed, the auditor relies on specific legal rights designed to prevent management from obstructing their work. First is the right of access. Auditors are legally guaranteed the ability to review the company's books and records at any reasonable time. They also hold the right to require information. Company officers are legally mandated to provide any explanations the auditor deems necessary to support their opinion. Furthermore, auditors have specific meeting rights. They are entitled to receive notices for, attend, and be heard at any general meeting of the company's members. The law also builds friction into the removal process. Management cannot quietly fire an auditor. Removing them usually requires a simple majority vote at a general meeting, governed by strict notice periods. If an auditor is removed, or if they choose to resign, they retain an ultimate defensive mechanism. They have the right to circulate a written statement of circumstances to the shareholders and regulatory authorities, outlining any issues surrounding their departure. These legal mechanisms ensure an auditor cannot be starved of data or secretly silenced if they uncover inconvenient financial realities. The legal layer sets the boundaries, but the actual execution of the work falls under the second pillar, professional standards. This chart illustrates the international architecture. At the top sits the International Federation of Accountants, IFAC, promoting the profession worldwide. A subsidiary board is the International Auditing and Assurance Standards Board, the IAASB. The IAASB's responsibility is developing the International Standards on Auditing, or ISIS. These ISAs contain the basic principles, professional guidance, and detailed requirements necessary to perform a high-quality audit consistently around the world. However, because IFAC is a grouping of accountancy bodies rather than a government, The ISAs they produce function as professional guidance rather than binding legal requirements. A globally harmonized standard has no impact unless it has legal weight. This international architecture must rely on individual nations for actual enforcement. Individual countries bridge this gap by implementing their own national standard setters and regulators. In the UK, for example, the national regulator responsible for overseeing the profession is the Financial Reporting Council, or FRC. The FRC performs a critical translation role. They take the globally issued ISAs from the IAASB, modify them if necessary to suit local needs, and officially adopt them, giving them weight within the country. National regulatory systems must constantly evolve in response to new, localized accounting irregularities. A prime example is the collapse of the UK construction firm Carillion. Another recent failure was Patisserie Valerie, which further exposed weaknesses and triggered massive reviews of the regulatory system. In response to these failures, the UK government initiated a transition of the FRC into a new regulatory authority called ARGA, the Audit, Reporting, and Governance Authority. National regulators act as the vital bridge. They transform global guidelines into binding local rules, complete with real punitive consequences for firms that fail to uphold them. The final piece of the regulatory scaffolding is the recognized supervisory bodies, or RSBs, like the ACCA. These professional bodies enforce rigorous upfront qualifications. An individual must complete exams and log practical experience before they can provide competent service. The requirements do not stop at certification. Members must pass ethical assessments and demonstrate continuing professional development to ensure their knowledge remains current. RSBs also possess disciplinary authority. If a member fails to comply with the rules, the professional body can issue fines, reprimands, or withdraw their membership entirely. These organizations act as gatekeepers, ensuring that only highly vetted, continuously educated individuals are allowed to step into the legal framework of an audit. Looking at this complete map, we see the auditor at the center of a massive system. They rely on national law to secure appointment from the shareholders, guaranteeing access rights. They execute complex work using international standards while remaining accountable to their local RSB. The goal of this regulatory machine is to empower the auditor to independently state whether a company's financial statements give a true and fair view. Auditors operate within a rigid, legally engineered system designed specifically to protect financial reporting from corporate influence.